if you're reading China information, it's good to consider both sides, not just reading the Western media. Read some of the media from China as well, right? And the best is go and visit and see, experience
for
it yourself,
yourself.
right?
See for
Rather
yourself.
than being an armchair expert talking about China but never stepped foot in China before. Which
See
I
for
find
yourself. Yeah.
if a Chinese has never stepped foot in US and they talk about US politics, right?
Yeah,
the
yeah.
Americans will say you don't know anything,
Yeah,
right?
yeah,
So
yeah.
I think it's the same thing.
Welcome back to Chills with TFC. I'm your host, Reggie, aka your Chief Financial Coconut. And today we are in studio to talk about important topic. I think recently there's quite a rally and then there was a whole drama, right? So like what's going on? What's the situation with China? I think a lot of people are concerned, right? So I'm in studio with Bruce and Alvin. For our audience that for some reason don't know you, would you like to introduce yourself?
Yeah, sure. Good afternoon, everyone. My name is Bruce, the portfolio manager and also the head of fixed income at CSOP Asset Management.
Okay, so what does the head of fixed income do?
Yeah, head of fixed income is do everything except for equity. Right? but actually, I have two roles. On the one hand, I'm responsible for the company's fixed income strategy, including the bonds, rates, as well as the money market funds. But in the meantime, since I'm based in Singapore, all the Singapore domiciled ETF also are under my coverage, including the equity ETFs as well.
That sounds like everything.
Yeah, almost everything.
Okay, so you're the right guy to talk to, yeah? And Alvin, for audience that don't remember you, for some reason, right? Yeah.
I'm Alvin. I'm the co-founder of Dr. Wealth. So we are a financial education company. We run courses and we do a lot of educational content, all with the aim to help level up the retail investor.
And you're the resident China expert.
No, I
Right,
don't know.
everybody-
I don't know why.
everybody-
I don't know why. I talk about US stocks. I talk about Singapore stocks. I do talk about China stocks, but somehow people always remember me
You get
as
boxed in.
I'm a China
Yeah.
investor. I don't know why.
Yeah.
Is it because I look Chinese?
No, I think because to be fair, right? I think a lot of people talk about the US market, right? We all follow it, and not so many people talk about the Chinese market.
Yeah.
And most people that talk about the Chinese market have a certain taint to their lenses.
Yeah, it's true.
Right, so from that point of view, then you become the
The
so-called
hated one.
No, you become the guy that everybody think like, oh, okay, Alvin got something to say. Maybe not so much hate, more objective,
Okay.
right? So that's kind of where it is lah.
Hopefully.
Right, hopefully. Okay, so maybe to kind of get us rolling, right? What is going on in the China market? I just came back from Guangzhou Hui, right? Then I hear all these young people talking about it, right? So curious, like what is going on? There's a rally, and then after that, what's kind of lay the ground for us.
Yeah, sure. Maybe since I'm originally from China, maybe I can share some. Since you are also were in China, right? I think the interesting part is that if you are outside China and you read the media reports, let's say from the Western, media, if you find that China is still struggling in terms of the economic growth, but if you're in China, particularly in some tier one or even the new tier one cities, you can't even feeling that China is slowing down. And also the most recent, let's say the Q3 GDP, 4.6% year over year. Is it a bad number? Actually, it's not that bad. We have to have a very reasonable expectation of China's growth because it has risen very quickly over the past 40, 45 years. So 4.6%, of course, is slower than a 5% target or slower than the pre-COVID era, but still a very decent number. And if you look at the breakdown of the growth, I have to say the export still one of the most stable contributor. This is partly because of the global demand and partly because of this China's complete supply chain, which is not that easy to be replaced. And also because of the lessons from the trade war 1.0, let's say 5-6 years ago, and also the potential trade war 2.0. Upcoming, or maybe the upcoming, almost certain, right? Upcoming trade war 2.0. I think some exporters, they have already reduced their reliance on the exports to the US, and some even they conducted re-exports, leveraging the third-party country like Malaysia, Thailand to avoid the trade barrier. So this round, at least the impact on the China, we think is less severe than the last round. I think that's for the export side. And from the investment or manufacturing side, we have not much concern because the government has more control and also related to supply side support. We emphasize more on the the demand side support, such as consumption and also properties. And my observation is that we continue to see the decent recovery of the rebound of the service-related consumption, such as in the restaurants or the tourism spending. But people in China still hesitating to spend on the big-ticket items like the including the luxury sales like the jewelries or cosmetics. I think that's one thing. And in terms of the properties, yeah, I have to say, even for now, both investment and sales are still slowing down. But the good part is that at least during the Golden Week, let's say at least the tier one cities or some new tier one cities, their sentiment are not that bad. And more importantly, there have been more and more supportive measures being announced.
Yeah. We definitely want to talk about it, right?
Okay. Okay.
Just wanna get clarity, right? Because you're someone with authority.
Yeah.
So like when you say trade war 2.0 is almost certain, right?
Yeah.
Is it like a like 茶余饭后 we gossip, right? Like we talk about Trump is back, trade war is back. You know that everybody talks about it, but from the ground, from the clients or from the people that you interact with, is it like all the manufacturers are preparing for this? Like what's the situation?
I think this time they are more well prepared, and some are even more optimistic after Trump or even before the Trump's victory. They have a higher expectation or they'd rather Trump would be elected. This is because this may imply that China may come up with an even bigger fiscal package, but China didn't. China still focus on their near-term risk resolution, but doesn't mean that this will not happen. What is missing doesn't mean it will not happen because Trump hasn't been onboarded, right?
Yeah.
He hasn't said anything. So I think they this time they are prepared, both from these entrepreneurs and also from these top levels.
Okay, fair. So there's two layers, right? The real economy and then the financial economy. We'll go there, right? Yeah. So Alvin, what's your read? You know, this overall this run up and then they came down, short period only, right? So like, what's going on there?
So I think Bruce covered the economy side, so I'll cover more of the stock market side, right? So we all know that China's stocks have not been doing well for at least the last 3 years, right? Consecutively, if we look at MSCI China for the past 3 years, 20, 21, 22, 23, all had negative returns. And that would have tested the most patient investors. I think that over the years, many have probably given up and have the idea that China is uninvestable, right? Then this year came a surprise. And the rally came after it appears that the government changed the stance and they wanted to stimulate the economy, whether is it loosening the monetary policy, fiscal policy, right? We start to see that change as opposed to more of the previous year. We see the government doing more clampdowns, doing more regulatory actions to certain industries, right? So it seems like there was like a 180 degree. Right? Even for the property market, it was loosening the measures rather than enhancing the measures as compared to a few years ago. So I think that change in stance is a very critical juncture because China is still a very top-down governance, right? If the top people believe that there's a certain direction that China should be going, usually it will happen. It will trickle down, right? It's not like the US is bottom-up. Entrepreneur drives where the economy is going, right? So the way that we understand China has to be different. Right, a lot of American literature will not work in China, so that adaptation is necessary. And with that, we see the stocks ran up. And during the previous interview, we also talked about foreign fund flows is important, especially in the short term for the stock market to be buoyant, especially for emerging market, which China is also part of the emerging market group. So we start to see big fund managers like David Tepper, Michael Burry, right, started to wade more into China and go on to like CNBC talk about, China is buyable, investable, and they showed with action, right? For example, David Tepper's biggest position is in Alibaba, right? The biggest in the portfolio, I think more than 10% in one stock. And that probably will give more confidence for foreign fund flows to go back to China. And I think some of the US investment banks will start to be more favorable. So I think with all this angle, one, which is the governance standpoint, and the other one is the foreign fund flow standpoint, is generally a good thing that there are signs that the China stock market is recovering.
So we first talk a little bit about the signal from the government first, right? I think even amongst a lot of the retail investors, right, suddenly there was like, hey, what's going on, right? Suddenly my Chinese portfolio recover, and then before I could really like, oh, very very happy, sit down and study a little bit what's going on. Then you know the rally receded, right, in some ways, right? So maybe we break it down into parts. We start from the part where the Chinese government signal, more market friendly, policies, right? What did they signal? What did they actually say? What are some, policies that are coming out? Maybe Bruce, you want to share with us a little
Yeah,
bit?
sure. I think what's different this time is not only from the monetary side. Monetary side very easy to understand, right? For example, even before the Fed cut or before the Trump's victory, China has some room for the monetary easing, but the Fed cut definitely creates an even more friendly environment for them to cut the LPR, cut the mortgage, and cut all the bank deposit rate. But what's different this round is that China, they have a direct support to the equity market, like the funding support or even the buyback support. The buyback is very common, let's say in Hong Kong and in the US, but now China also have paid more attention to this. And additionally, specific to property market, this round, of course, they still have the supply side let's support like the debt swap to relieve some pressures from the local governments and also the developers. But I think demand side support, like the direct lowering the, let's say, the purchase restriction, lowering the down payment ratio, and also more importantly, lower the mortgage rate, particularly for those existing borrowing costs. This can directly lower these China's households burden. So I think this is more than welcomed. I think we need more this kind of demand side support. So that's why the investors, the reactions are very, very, very strong. So this round, at least, I can't say the strategically China stock market may already has its own picture, but at least from a tactical trading perspective, now in onshore China, they are quite confident. So as this is already echoed by the improvement in terms of turnover, in terms of margin financing, and someone are even doing the T0 trades to take advantage of the improved volatility and liquidity.
Okay. So why now then? Right? Like it could have, why the Chinese government want to do it? Of course, I know if we really want to hear, we must hear from the horse's mouth, right? So we welcome you, right? If you want to come into the studio and share with us, we're happy to have you. But from an observer point of view and someone from the industry's point of view, right? Why is China changing its stance now? Because it's been a while, right?
Yeah, it has been a while. Yeah, maybe later you can add more. I think because if you look at long-term strategy from the Chinese top leadership, they still have to double its GDP from, let's say, from 10 years ago to 2030 to double its real GDP growth. So the implied growth rate will be roughly 4.7 to 5%, not 10%. So from this perspective, they still need to achieve their annual GDP target. I think that's one of the reasons when maybe even before the Q3 GDP was released, they've realized that if the GDP growth is like this, they may not be able to achieve this annual growth target. I think that's one part. And the other reason is that, of course, if we go back to 3 years ago, right, the crackdown on the education and technology or even the property. At that time, because China's growth was still quite okay, so those kind of crackdown is more for a balanced economic growth and also narrow the wealth gap between the rich and poor. But since the late 2021 and early 2022, when the outbreak of Omicron also locked down in China, and together with these aggressive hikes from the Fed, they realized that, of course, the property, particularly for the property sector, can't be overheated. It can never be a drag to China's the whole economy, because if we include the upstream and downstream, actually the property growth contribution to the China's GDP is actually 30 to 40%. So that's why they realized that they need to stop this or even reverse this through the both sides supports, like the supply side support and demand side support. And for equity markets, it's the same, because equity markets, if the Chinese wealth majority is in the property, and the other part, the second important part also within the equity markets, the long lasted, let's say, decline of this stock market together with the low volatility will kill this capital market together with the wealth of the Chinese public. So that's why they need to save the market from this previous low level. So that's why we see more and more rebound in recent months. This is particularly if you combine with the external environment. If the US is facing some growth challenge, if the stock market will finally decline from its peak, then what is the next? Japan equity, they used to see a very strong rally, but Japan, the underlying corporates, their fundamentals linked very closely with the global economic growth. So if US strong, Japan equity should be okay because US strong, US dollar strong, Japanese yen is relatively cheap, and Japan, the underlying corporates, they can still leverage the export advantage and the global strong fundamentals. But if US and Japan, they both see some slower growth, not a recession, of course, then China are still the next one that investors should consider.
Okay. What's your point of view?
I think Bruce covered a very good point about the economic slowdown, so there was more urgency, right? So from a monetary standpoint, I think the rate cut is a very good opportunity for China to loosen their monetary policy, right? I think Bruce touched on that as well just now. Because we know that when US were hiking the interest rate, that strengthened the US dollar, right? And that leaves very little room for China to cut interest rate. Then the renminbi will weaken. Right? And then the delta
Fund
between
flow,
US
right?
dollar
Yeah.
and renminbi will be a big issue. And yes, there'll be capital outflow from China. And a lot of the property developers, the bonds are priced in US dollars. And that will probably cause the developers to sink deeper into that, because now then to repay the interest in US dollars, right, when they earn in RMB, right, that heavy forex losses will worsen the situation. So that essentially will harm the property sector as well. So that's why I think that US rate cut is very welcome, and that created more room for China to cut the rates. And that's why we started to see right after the first rate cut, 0.5% cut, the monetary stimulus came in, right? It was just waiting for that moment. It was just waiting for the Federal Reserve to cut the rates. So that's one. And the second is, I think it seems like there was a change in stance at the start of this year, where Premier Li Qiang said something about the stock market needs to be revived, right? That was also something that was, to me, a very important juncture. Prior to that, China has always focused on the economy. Right? Economic growth is more important. Stock market is just a facade. It's just a cosmetics, right?
Is that a fair statement?
I think
Have, don't have, never mind.
at the end, I have to say, even after this rally, September rally, the valuation in China and in Hong Kong, they're not expensive. Their earnings are not that bad. So it's more about how to restore the confidence to add back the multiples to the equity market. So I agree with Alvin. It's about that the financial market, equity market, in the middle to long term, is a result of the economic growth.
I mean, if we go by the value, thought process, right, it is like very, very cheap compared to other places, right? So
So the significance is that statement from the Premier at the start of this year, right, is significant because it tells people that yes, now the stock market is important. It's an image problem. Your economy, you can tell people I grow at 5%, I meet my target. But if your stock market is down, foreign investors will look at China as bad, right? It's because the economy, only the citizens will feel it, whether the economy is doing well or not, right? But externally, people will know. And how will people feel? If I put my money in a China stock and stock go down, means China is bad, correct? I don't care whether the economy go. It doesn't benefit me. Okay, so I think that's from the image perspective, and I think China always have an image issue. So because it's harmed by a lot of Western media portrayal of China in a very negative light.
Bruce got a lot to say.
So I think the branding of China needs to improve, and I think this stock market is one of the branding areas. The stock market needs to do well in order to look nice to the rest of the world.
It's just that.
So that's my
that's your point of view.
second point of
Okay.
view. So when that happens, that's where all the China national teams start to buy up the assets domestically, right, via ETFs, all these kind of things. So same thing is a top-down thing. When the top or the first or second man decide that this is the way to go, usually the policy will trickle down. Very, very predictable in that sense.
Hey, welcome to the Financial Coconut Podcast Network. I'm your host, Reggie, aka your Chief Financial Coconut. And if you're loving what we're creating here, like, share, subscribe, share with your loved ones, comment in the comment section below. And we'll see you for great content on Chills with TFC. Okay, so I want to push that thought a little bit, right? Because I think it's a fair statement to say that the Chinese manufacturing is strong. You know, it has its whole supply chain thing sorted, which I think is a fair statement. It's very hard to argue against like the Chinese, can produce a lot of things, very well. And I think it's unlikely to be challenged in a short period of time, right? But reality is growth from there is not as exciting for a while, right? Because for whatever reason, there's a prevailing US-China problem, and then even a lot of the sellers are trying to reposition their sales channels to Southeast Asia and other places, then they take a hit on the margin. Generally, they're all experiencing that. We had some people on the show, so we kind of get a sense of it. And when I was at the Canton Fair, I think that's the general sense. Right? They really want to work with you. It's like, it's like, who am I? Why you want to talk to me? And they really want to follow up. So, from that perspective, it does feel like the Chinese merchants are working very hard to find new markets to sell, right? And by extension, it does mean that although they can probably keep the supply chain, not lose it, because if the market is down, their whole supply chain is gone, right? They probably can keep it, but unlikely they will be going at that same level of margins. So my theory is because that is the situation, so the financial market development become the next push at the top for that growth lah, right? Is that a fair statement? What do you think? Is it a branding or am I more true?
Maybe I still start from the macro economy. On the back of potential tariffs or the challenge to mention, the geopolitical tensions or the supply chain shift, right? This round simply lower the FX may only solve some near-term challenges, but since China is also already upgraded its supply chain, you can't simply let your export surge because of this lower maybe FX rate. And also, as I mentioned at the beginning, the investment support, manufacturing support, they are all on the supply side. If there's no demand to match them, then you have an oversupply issue again. So that's why everyone is looking at consumption. So last Friday, they didn't mention that. So which already disappointed the investors. But once again, it doesn't mean that it will be gone. There are still some measures. They are waiting on the maybe in the corner. They will finally make them available. Consumption, I think, is not surprising because every major economies, when they're experiencing from let's say the emerging markets, developing markets, developed markets, they have this kind of stage. So the consumption contribution or the ratio versus the GDP, China still has a lot of room to grow. I think that's why. And more importantly, you can see how China, particularly for the foreign investors, they are cautious about China's growth and in turn cautious about Chinese equity market. But Chinese public, they still have pockets not just because money in their pockets, they have not pockets, not only pockets,
Savings, right?
right?
High savings, right?
Yeah, very high saving rates,
saving rate.
40%.
It's more about when they will spend. Now they only spend, let's say, the food, the tourism, which anyway will not be deflated. Once they consume it, they get it. But doesn't mean that they don't have money. I still want to share my experience in Chengdu because when I walk around in the shopping mall, in the hotel, or in the restaurants, I think it's quite okay. I think China is getting faster. Maybe perhaps we are seeing a uneven China recovery. Maybe in the North China for tier 4, tier 3 cities, that's really struggling, both from the consumption recovery and also the property market. But in tier 1, particularly for the new tier 1 cities, they are now quite okay, particularly for those cities in West China. Why West China? Because like the cities like Chengdu and Chongqing, their property prices are listed impacted by the previous property downturn because their property prices were naturally historically low, which means their downside is very limited. But now they have some upside potential because of the population being concentrated, at least from West China, they're being concentrated in this region. And so for the capital cities, let's say of the province with a large population, young population, and even the population inflow, there's still a good reason to launch them. That's
okay. And how does that then translate into the financial markets, right?
Yeah, maybe the stocks related to Chengdu seems that's part of it. That's definitely part of it. But based on our observation since September, the best performing market in onshore China is the China growth stocks, like the stocks we discussed it before this call. It's about these stocks listed on the star board. Yeah, that's the best performing market in the onshore market, and in the offshore market. let's say our Hang Seng Tech strategy, also very, very popular because they are not only because they are cheap, because they have also very good quality names like the technology names, like the platform economies, and also some electric vehicles. So those names are anyway are quite good even before this round of stimulus. And some are even benefit from the consumption downgrade. In the past, they went to the luxury stores. Now they buy them online. And for electric vehicles, also the same. In the past, they maybe bought the BBA. We call BBA the BMW, the Benz as well as the Audi. That's a BBA in China. But now they have an even efficient, cheaper, with good fashion in terms of design, the domestic EV supply. So why not? The acceptance of the domestic produced EV. And for EV, it's no longer a competition of this engine. It's a competition of the EV battery. But EV battery, in terms of EV battery, China also a leading producer in the world. So that's why all those names are still with good quality, cheap valuation, earnings look resilient, used to drag by the China image. But now, since China image maybe just reversed maybe halfway, they already rebounded a lot.
Yeah, interesting. Okay. And then shortly after the rally, there was like a dip, right? So help us understand, like, what is your read on the situation, what happened, and all that.
This time, I think at least they create a range. We can simply treat September 24th as the bottom. It can't be, after this round of stimulus, it can't be worse than September 24th. That's the bottom. Yeah, that's the bottom. And this floor actually further consolidated on October 17th. That's the second floor. And of course, there is a ceiling. October 7th is the ceiling, which also locked some new investors, locked on them. But any volatilities within this range, we still see the tactical trading opportunities. But if, let's say, in the December CEWC, the Central Economic Working Conference, or even the NPC next year, if any powerful fiscal and property supportive measures, including the consumption supportive measures, some maybe more for the domestic pressures, some maybe against the Trump's statements, then it is possible the China equity market could rise, both China and Hong Kong, beyond this range.
Okay. Yeah. What's your take?
Fundamentally, I think we all agree.
Yeah.
It's still cheap, right? Despite the upturn this year. On the technical analysis aspect, too bad we don't have a chart here. But generally speaking, the China equities have hit at least a 2-year high, right? And definitely clear the bottom. In fact, I think the bottom was maybe October 2022, right? A few years back. Right, they have never revisited that level, right? Even though they go up and come down, they have never and that's very important from a technical analysis standpoint, right? You don't want to have lower lows, you want to have higher highs, higher lows, right? And that has been seen in the China stock market. And granted, China stock market will always be very volatile, right? You go up 10% a day is possible, come down 10% a day is possible.
Can you explain a little bit why?
I think it's got to do with the presence of institution, because institution, the money is stickier, right? It stabilizes the market. Just like in Singapore, for example, a lot of companies, the bigger ones, are Temasek owned.
That's why they move.
Temasek won't trade. They won't trade the stock, right? So which means the stability is there. You only left a small float for
stability is a nice way of putting it, right?
It's a double-edged
But it's
thing,
true.
right?
It's true. Yes, there is.
So
a stability.
in China market, you probably have a lot more retail investor participation, and they can tend to be more fickle-minded, driven by greed and fear. They may trade more frequently, and therefore, when there's a sign of volatility, they actually enhance the volatility because they are the one that created that volatility in the first place.
Okay, fair. So is there space to then deepen institutional presence in China? From your point of view, I mean, you are knee-deep in the industry, right? Probably you always hear all these people talking about it, like...
If I may, actually, the ETF development is a good sign.
Oh, yeah, that's true.
I heard that the ETF, the volume is higher than active funds already.
Oh yeah, that's true. Now I think the more and more they believe in the beta story instead of the single stock.
That means you guys are doing a good job, right? Influencing.
Exactly, because the single stock, it's nothing wrong to pick stocks, but you also need subject to the concentration, downside, and drawdown risk, as well as the liquidity risk. Actually, when I was in China this round, we see more and more retail investors and also the high net worth, super high net worth, maybe also the entrepreneurs. They start to embrace for the beta, the markets. We also discuss about the with 500, not 850, because they really want to, what I heard, based on what I heard, not proved, but I heard they really want to develop a representative index to include these the value stock, growth stocks, and some offshore stocks to create a similar version versus the S&P 500. Yeah, of course, if the real China, if you want to create a representative universe, it could be A share, A500, the Hong Kong shares, Hong Kong tech and traditional financial the banks, and also the ADRs. I think that's the real China. And this time, I think for now, of course, we are really constructive on the China growth story. If the implementation continue to be in place, in progress, and also the recovery, we see some meaningful recovery, maybe consecutive 2 or 3 months recovery, then we are constructing on China growth story. But the expectation between the foreign investors and the domestic pace of these stimulus, I think they still create some volatilities, just like the last Friday, right? 10 trillion package, 6 trillion on the increase in the local government bond, and also the 4 trillion of the special government bonds. It's not that bad. The number is not that bad, but still focus on a risk management instead of these consumption support. Then it already creates some volatilities, but it's more for the tactical trading. But in the meantime, if it takes more time for China to see real recovery or real powerful implementation, the China SOEs and the central SOEs with the decent dividend features, those are key stabilizers. Actually, in fact, even last year, and year to date, maybe the first half of this year, those names can still achieve a high single digit and double digit growth. So that's why in China, we not only have those growth stocks, but also have those value stocks.
Fair. So you know, the whole idea now is kind of like two-prong, right? There's one prong where it's trying to stimulate the physical economy, right? And that's kind of where everybody is talking about, you know, like there's all these policies to adjust interest rates, you know, stimulate consumption, and you know, there's a lot of savings sitting around, right? So that story is intact. I think nobody is really challenging that story or really questioning it. I mean, the way people question it is like, is this enough not, right? Is the stimulus enough, or you know, can the time decay kind of manage itself, right? If not, you know, if it's too slow, then the thing will collapse, right? So there's some variance, but pretty much everybody is like, oh, okay, yeah, physical economy needs to be stimulated, right? So that's the basis.
Yeah.
And then
I think that's where the problem comes in, because after the September 24th big stimulus come in, right, the expectation had gone up, especially with Trump now in the office, and now people are looking at China. What's your response, right? That caused the expectation to keep going up and going up. A big stimulus must come, especially in the physical policies, right? It must come, it must come. Then every time there's a press conference, right, there's getting more and more. I lost track of the press conference anyway, which is a good thing, right? Which is a good thing. They are coming in bits and pieces, and definitely much better than say 3 years ago. But when the expectation is not met in the press conference, then the stocks will have some reaction. Right? There will be some sell downs. So now it's not about whether China is creating these policies to support the economy. It's more about whether they meet the market expectation, whether they exceed it. Right? You need to exceed it now. So the bar has risen.
So that's where I'm leaning towards, right? The physical economy side, it is what it is, right? People already kind of get a sense. I think the government is along the same lines already, right? So there's not much debate other than you know, magnitude, right? But then the question is, does it then translate to the financial economy, right? Whether is the Chinese government ready to go deeper in the financial economy, right? Like whether are we going to get more institutional, you know, money coming in, you know, or like more foreign capital coming in to stabilize it and develop it, right? That's the part that's a little bit of a question mark, right? At this point in time, at least it does not feel conclusive enough, which is why there's a lot of retail in the market. It creates volatility, and then from an external investor standpoint, it's like, do we really need this, right? So there are other places to put our money, right? So just want to hear your take on like this deepening of the financial economy. Is there a direction there, or is
If I may, I go first.
Yes. So go first is smart one. 先讲, right?
If you look at the global asset management perspective, right, it's not deniable the largest hedge fund, largest mutual fund, largest ETFs is in the US.
Yes, they are
right?
all in the US.
And because of that, I believe that's why the US stock market always worth a premium compared to the rest, because US markets will always be seen as home to all this money, and it's always safer to, of course, invest in home. right? So they always command that premium. Of course, people can argue that fundamentally US companies better, blah blah blah. But I do think that there's this fund flow perspective that needs to be considered as well. And traditionally, when risk on mentality is there, the Americans will start to invest overseas, right? And that may include China and all other emerging markets, right? When the risk off mentality is in, then they'll pull money back from these shores. So that also creates a volatility, you see, right? Good times, China market can go up. Bad times, when US money pull out, then China markets will go down. And I think increasingly it's difficult to rely on US fund flows to support the Chinese stock market, because we all know that 已经翻脸了, right? The geopolitical tension, there's no way to go back. Whether it's a Democrat or whether it's a Republican, it's never going back really. So I think the reliance on US capital is going to be very limited for the Chinese stocks. And therefore, the domestic support is very important. And the Chinese national team buying using the sovereign wealth funds to buy and stabilize the market, I think increasingly is important. But instead of retail investors buying directly for stocks, I think the advent of this ETF and the popularity of it is good, right? Whether is it mutual funds or ETFs, but that also creates stability.
Because it's a bit more patient this time.
These are more patient capital, and you need this bigger institution in China to rival those in the US. And I think another development is brokerages in China is merging, and they try to create their own Goldman Sachs version, hopefully, right? But all this will take time, because I think now China is in a transition, not in terms of just the economy, where they are trying to restructure into new economy, high quality growth, right? Instead of property driven kind of development, but even in the capital markets, right? Where you need more patient capital to have that stability, not during times bad, money get pulled out from the market, right? That really affects the image. So I think it will take time. I don't think the volatility will go away anytime soon, not in the next few years. So not easy for foreign investors, I would say.
Yeah, fair. Yeah, Bruce, what do you have to say?
This time, at least they provide direct, cheap funding for those institutions, asset managers, insurers, and some brokerage firms to invest in these equity markets. I think that's a good start. But whether they can be, let's say, persistent, I think remains a question mark. But also based on my observation, a lot of investors, they get bored of this theme investment. Not the theme's not good. Just like there is a theme, okay, they get a very sharp rally and then quickly go down, cool down. They'd rather like a very stably increased equity market together with the healthy macro growth, and particularly using the fund or ETF. I think they would rather like this kind of story versus the previous single stock bets, maybe just buy day one, maybe sell in day 2 or day 3, these kind of things.
Okay, so essentially it will take some time, but it looks like it's in the right direction. There's a bit more development there. Eventually it'll be deeper, more stable, and then it will probably welcome more capital coming in also.
I think we can take reference from maybe 10 years ago. A lot of people will see China as cheap products, correct? The same as what has been for Korea, China, Japan before, right? And then they turn quality, right? So I think, especially in the last few years, I see there are big brands coming from China, and the recognition of these brands, the confidence in these brands have risen, right? Of course, the hottest will be Labubu right now, PopMart, right? They are China equivalent of say certain US brands, right? Huawei is coming up, Xiaomi has done well, even have a very nice car. Too bad it's not in Singapore.
Not yet. Please come. Yeah.
Like I even look at the one of the, and there's fundamental growth. It's not just the stock price going up. Like PopMart, there is real revenue growth, right? So even if you look at some names like Bosideng, which is the down jackets, right? You have very credible foreign players like Moncler, Canada Goose, right?
Yeah.
So if you compare the growth, Bosideng wins in China, right? In terms of is the biggest, right? So there are such, I would say, world champion potential, okay, at a global stage, that eventually China will be able to create.
Yeah.
So I would say that the transformation is a matter of time, right? And nowadays even iPhones are made in China, right? So
Yeah,
The quality is there already.
Okay, fair. So I think the unanimity is the growth story is intact lah, right? But it's not for the faint-hearted lah, right?
Yes,
Like from
correct.
the fundamental story is there, right? But from an investor standpoint, you gotta go in with your eyes wide open.
Major teething issues.
Yeah, major teething
Major
issues.
that will take years.
Okay, fair. So any last things you want to share with our audience? That has any other common things that people think about when they think about China?
My last wording is that at least this round, the onshore investor, their confidence are coming back and continue for now. And based on our ETFs observation, some of offshore, like the Hong Kong stock, they are also the inflows are also returning to these kind of strategies. Again, not every single let's say corporates are subject to the same level like the hard tech, right? Because the chips to be used. So there are a lot of soft tech consumption play. Like you mentioned, so all these are still in a better position, good position, and now it's a good chance for trade them or even hold them in the long term.
Okay, fair. Any last things? I think you shared quite some good stuff.
I would think that if you are reading China information, it's good to consider both sides, not just reading the Western media. Read some of the media from China as well, right? And the best is go and visit and see experience
for
it
yourself,
right?
see for
Rather
yourself.
than being an armchair expert talking about China but never stepped foot in China before. Which
See
I
for
find
yourself. Yeah.
If a Chinese that never stepped foot in US and they talk about US politics, right?
Yeah.
The Americans will say you don't know anything, right?
Yeah,
So
yeah.
I think it's the same thing. I think Western media tends to have that issue. Right? They probably have not understand China enough. They have never been to China, but they have been talking about China like they are day one expert.
Yeah, fair.
So I think having that critical thinking is very important.
Yeah, fair. I think recently Thomas from City Compounding also went to China, and then I see his feet start to change. so you can tell, right? Like when you're there, you see a different perspective. You see how things are really playing out, and then you can make your own judgment from there. Add it into your models, right? And then evaluate from there. Okay, so with that, thank you for your time. Thank you for spending time with us. We'll see you in the next week's episode. And if you have any question, put in the comment section below. Oh yeah. Maybe before we go, if they would like to connect with you, where is a good place to connect with? LinkedIn, or
LinkedIn is okay. WeChat, if you have.
Okay, great. And LinkedIn is a good
social
place.
media, yeah, LinkedIn,
Okay, great. So with that, thank you for your time, and we'll see you next week. Take care. Bye.